We do have everybody. Let's go ahead and get going. Everybody hear me okay?
Yep.
Yes.
Okay. We will call to order at 3 p.m. Let's see, no public, so any board communication? Unless Bob, you wanted to say something in public?
Yeah.
Oh, do you?
No.
Okay. Yeah. Okay. I don't have any communications, so we'll go on to the finance director report. We are staying away from each other. Camera's on. Oh, she's mad at me now. I left the camera on.
I don't like that camera to be on. Good afternoon, everybody. This is
Hi, Cindy.
How are you guys all doing?
Great.
Doing great. Good.
Good. Well, this is the third quarter of the year, and I don't think that anyone looking at this compared to the December quarter is surprised at what has happened in this last quarter. But we were at 131 million last quarter, and we're now down to 112 million dollars. So hopefully in the next, I don't know how long, I'm not going to even hesitate, begin to guess how long that we would start to see that recoup. But it's pretty much basic. The expenditures and the pension payments are pretty stable. So if anyone has any questions about the report, I'll be happy to try to answer them for you.
Cindy, this is Mark. Is the 112 as of today or March 30?
No, that's March 31st.
Okay, thank you.
That will tie to the SEI report. And I think typically SEI would give us the balance as of today when he gives his report.
Yep.
Right. Yep.
Thank you.
And it's going to be like 130, I think.
Yeah, 135.
Oh, there you go. Thank you.
Okay. Has everyone read their minutes? And I entertain a motion if anyone's so inclined to approve the minutes of February 13th.
This is Jason. I make a motion to approve the minutes.
Okay. Do you have a second? Nobody? Anybody there? Hello? Mark, did I hear you make a second?
Sure.
Okay, we have the first and second. Any discussion? If not, all in favor, vote aye. Or say aye.
Aye.
All opposed, same sign. Motion carries. We have the authorization of payments from retirement funds for retirement benefits. 2020-291, we have 4 of them.
Is Carol there? She usually makes the motion.
Yeah, she's there. Oh, she was. Did Carol drop off? Yeah. Oh, I think we lost Carol. Did I? Yeah, I think she dropped off again. She was there a second ago.
Well, if it's okay with everybody, I'll move all of them at once. All 4 of them.
Okay, do we have a second?
This is Jason. I'll second it.
Was that Pollard?
No, that was Jason.
Yeah, Pollard. Yeah.
Oh yeah, Pollard.
Sorry.
Yep, sorry.
That's right.
Okay, all in favor say aye.
Aye.
Aye. Opposed, same sign. Oh. Okay, where's that now? And Carol dropped off, so I'm just kind of keeping an eye out for her to pop back up. SCI investments. Pat, you want to get us going on that?
Okay, great. Thank you. Why don't we move ahead? Hopefully, first of all, everyone's safe and your families are safe in this difficult time. I know this quarantine isn't easy. It's a whole different kind of approach to life. So hopefully everyone's doing okay. I'll move ahead to page 4. Really just kind of wanted to just touch on our model again. Because during this time, we're all working from home, our entire organization, with the exception of some key personnel in our office down in Oaks, Pennsylvania. But we have very strong technology, and there really hasn't been a blip in the radar. You know, our clients, we've met all of our clients' cash needs. We've really taken a strong look at rebalancing and when to do that and not wait till the end of the quarter when the rest of the universe rebalances. We took advantage of that last month. We rebalanced again. We're actually rebalancing again tomorrow. So we didn't do a full rebalancing last month. We did a partial, and we're going to do go back to full tomorrow. So we were just being cautious because there's articles out there, you've seen some organizations with their rebalancing losing a lot of money because they're all doing it in one day, and it's just creating a lot of liquidity issues and extra unnecessary costs. So that's one thing that we really focused on to help our clients. And then also, again, daily liquidity in our funds. There really hasn't been any blips in the radar there. And we just have a strong governance presence. So I think that's just really important. We have a lot of resources, a lot of technology, and that's really helping us and help our clients during this period of time.
Hey, Pat, what's the current value?
The current value is just over 118 million. So we gained about 6 million since the end of March.
Pat, I have a question on rebalancing. Do you, when you do a partial rebalance, how do you treat the benchmark? Do you try and keep the benchmark kind of rebalance relatively in sync with the portfolio, or is there some tracking error there because of that?
The benchmark is not impacted by the rebalancing. So we look at each individual fund at a 2% variance. So we only did a quarter of that back in March, or was it? No, it was that was in March actually. We didn't do any rebalancing in April. That was before the quarter end in March. So no, there could be some tracking errors related to rebalancing, but all in all, from what we've seen from the rebalancing trade we made then, the timing was pretty good. We actually made out because of it, and all of our clients did.
Okay.
And the more recent one, obviously, we're not going to know until tomorrow, but we're going to go back, get everything within that 2% variance.
Yep.
So just a couple of things I wanted to touch on. Obviously, these are unusual times, unprecedented times, a lot of volatility in the markets on a day-to-day basis. There's really nothing that compares to what's happening now. And we can look back at the credit crisis, obviously, as somewhat of a comparison, but it's really not. I mean, the markets have shut down essentially across the globe. Supply chains have shut down. But I still wanted a perspective just looking at past pandemics in history. So, I went back to HIV AIDS in 81 and just looked at, that was the only time, I actually looked at 12 of them. The only time the markets were negative after that pandemic was contained or ended. Obviously HIV didn't end, but was contained somewhat. The markets recovered pretty strongly in every single scenario with the exception of 1981. So the one I really focused on was SARS back in April of 2003 is when that ended. It was quarantined very quickly, contained very quickly, unlike the current situation we're in. But you have to remember back then, the economy was much different. It was a global economy, but just looking at China, for instance, they were only about 4.5% of global GDP at that point in time. Now China's close to 18% of global GDP. So it's a much different world we live in today. We're much more connected across the globe. And this COVID-19 has had a significant impact globally and just shutting down supply chains and just really putting fear into the market. And obviously, the question is there a light at the end of the tunnel? Will there be vaccines? When will that take place? There's just a lot of unknown questions right now. How much longer will we have to be quarantined? What else is this going to impact? Will there be an NFL season coming up? Will baseball come up? Basketball. I mean, these are all things that are going to impact global, well, not just global economies, but also, local economies, cities, states. So there's a lot of things going on here. So there will be volatility to continue until these questions are answered. The good news is there's about 100 different vaccines being developed right now. We're hoping one of those are developed. We're not, we don't anticipate that the vaccine will be ready until maybe next year at the earliest, and that's being hopeful, because if you look back at other pandemics and viruses, it takes a lot longer than 12 to 18 months to create a vaccine. Some haven't been created, some still haven't been created till today. So, and influenza took a lot longer to come up with a vaccine. So I know there's a lot more presence on this, a lot more money being dumped into it. So I am hopeful that there will be something hopefully within that 18-month time period, but there's really no certainty around that. So that's kind of where we're at right now. I think we're going to maintain this volatility until we really kind of get some more clarity around some of these answers.
Hey, Pat, were you surprised at all with the rebound in April, given that level of uncertainty and the unemployment figures that hit?
Yeah, I wasn't necessarily surprised because I think a lot of that came from the huge amount of money that the Fed was putting into the system, right? I mean, a $2 trillion package, and they're talking additional monies going in as well now. There'll be some back and forth. I mean, Democrats came out with a $3 trillion plan. It's going to go back and forth for a while, but I think they're going to dump more money, into some of these small businesses that are being impacted. Maybe even some sort of pension reform, and hopefully help some of the public plans and Taft-Hartley plans. But I think all in all, the market responded to that, but also responded to some of the noise out there saying, okay, well, maybe we will have a vaccine sooner than later. But I just want to be cautious because, looking over history, vaccines don't come out that quickly. You have to go through these trials. You have to make sure that there's a safety net around it before you can start distributing a vaccine to individuals.
Thank you.
So why don't we move ahead to page 7? You can see here, risk assets, right-hand side of the page, major sell-off. Smaller companies got hit harder for obvious reasons, right? They're just not open right now. Small restaurants, movie theaters, any public venue like that is just shut down. You might be lucky if you can get curbside service for some of these restaurants. I know a lot of my friends and stuff have been trying to help the local restaurants by getting curbside whenever we can. But, just devastating returns here, both for the 1 year and for the first quarter. Obviously, all the volatility happened in the first quarter, and we had that rebound in April. So the only strong points as far as asset classes were investment grade bonds, and long duration bonds. So in this scenario, the longer you were in duration, so the longer maturity bonds you had, the better you did. And that's held through for this entire year. Obviously we have and we'll get into the fixed income in a minute, so I'll talk about that. But overall risk assets just sold off pretty dramatically, which can be seen on page 8. Just the pure amount of volatility we've experienced is unprecedented. So what we did is we basically took June 17th, which was the top of the market, through February 20th. And just to show, actually it wasn't the top of the market then, but we just wanted to show the volatility for that period of time. And you can see just large swings, mostly to the downside, but then we had a pretty good recovery there as well. So this, you can see there's pretty tremendous volatility. And that continues today. I mean, on a daily basis, it's not as bad as it was, but we still continue to see, pretty strong down days and up days, just not those, 7% to 10% up days and down days. Bonds, bonds are all-time lows in yields, right? So I think today the 10-year is right around 0.60%. So, that you have to ask yourself that question, right? So if you have an actuarial assumption rate of between 7 and 8%, how likely is it you're going to hit that in the short term? It's going to be difficult because if you have any fixed income in your portfolio, you're not getting a lot of yield out of that portfolio. So you're not going to see a lot of, you're really relying a lot on the equity engine of your portfolio to get those numbers. So what you're going to see, and I'm sure everyone else is familiar with this, all the professionals, that you're going to start to see capital market assumptions come down as a result of this. So on a 10-year basis, I'd expect equity returns to be muted and come down, and fixed income because of where interest rates are. So if we had an expected rate of return over a 10-year period, let's say 6.5% for your portfolio or 7%, that might come down a full percentage point. So that's something we're really going to have to work with your professionals to see, do we have the right strategy? Do we really want to risk up right now just because of that? Or do we want to just kind of sit back and wait and see if the markets, come back to somewhat of a norm over time? And on page 10, I wanted to speak to the yield curve again. I know we talked about the inverted yield curve in the past. This goes back 1 year ago, looking at the US Treasury curve on the left-hand side. You can see we had a slight inversion on the short end of the yield curve, where your shorter end maturities were higher than your kind of 2-year and 3-year and 4-year. And then we had a kind of a nice smooth ride from there. But then you move on to 1 month ago, you saw that yield curve inversion get pretty dramatic there. We talked about yield curve inversions, how on average, 17 months down the road, you have some sort of recession. Well, we have a recession now, basically, not essentially confirmed yet, but because of the pandemic. So it wasn't really related to the yield curve at this point in time, but we're there now. Now, looking at November, you can see the yield curve steepened pretty dramatically with very low rates, obviously. But the yield curve inversion is essentially gone. If you look at the Fed funds rate now, it's between 0 and 0.25%. So they brought rates all the way down with a couple of rate cuts. And we started to see a nice steepening of the yield curve. So that yield curve inversion is gone, but we're dealing with a pandemic now. We're also dealing with the side of this slide, unfortunately, oil market disruption. We've seen major declines in oil prices that are impacting a lot of producers around the globe, and frankly, much more in the United States. So we're having kind of a double compounded impact here from a pandemic, a disruption in the oil markets as well at the same time. Any questions around the yield curve or oil markets? I mean, the good news is gas prices are down, but no one's driving as much. So
We're driving every day.
Yeah, this is Tim. I would just sort of echo the sentiment of when you look at sort of where bonds are now, where yields are now, where bonds are going. If you're trying to contribute some capital appreciation to your portfolio, you have no choice but to take risk somewhere, an equity risk. And I know the 10-year capital market numbers are going to be knocked down. Longer numbers will probably need to be shaved off a little more because that's where the industry is going. But technically, it's not clear to me that if you're looking at a 20 or 30-year horizon, that this is any more than just sort of a market blip. But you know, we'll argue that when the day comes, I guess.
right, that's a good point.
Yeah.
Finally, you can read through the summary I put here. I just wanted to take a look at, various market cycles and downturns in the market. So there's 3 bars here. One's a yearly gain, which is a green bar. This is on an annualized basis. The red bar represents a yearly loss, so the entire year. And the dotted red line bar represents the intra-year drawdown. So you'll see in many cases, going back even to 2008, where the drawdown was much more than where the market ended up, even though it still ended up down significantly that year, obviously, for the credit crisis. But the good news is in many periods like this, it is somewhat normal to have these corrections, just not this quick and this strong, just over a couple-month period. But we have seen that markets have rebounded over time. So kind of just to end on a positive note there that, there will be light at the end of the tunnel with the market. We might go through some tough times of volatility, but at the end of the day, we'll pass that 130, 135 million mark. It's just a matter of when. Any questions around the front end?
No.
Okay. So page 16, just looking at the portfolio cash flows going back over the last 3 months. This is a March report. So for the quarter, obviously we had net negative cash flows of 2 million. And then obviously with the huge down markets, we were down 16 million. So a net negative experience overall for that period, which shouldn't be unexpected. And then on page 17, the portfolio held up pretty well. I mean, I compared this to some other portfolios and strategies and structures, and it did quite well. Looking at it on a fiscal year-to-date basis, you're down, about almost 7% there. Net of fees, just over 7%. We did outperform the index there, which is a gross of fees index. You could see March was a difficult month, obviously. We were down 9%, and then February was difficult as well. So the 3-month numbers are down pretty significantly But we did have a nice bounce up in April, and hopefully the next meeting, since we do it on a quarterly basis, we'll see some of those numbers rise during that next meeting. As far as the strategies overall, I mean, everything performed pretty well. And I know Tim will get into this a little bit later. Overall, the strategies did well for the quarter. No major underperformance anywhere. High yield did underperform. With fixed income, I didn't mention this, but last month, there was a major disruption within credit securities. So what happened was credit spreads blew way out because of liquidity issues in the markets. And we saw all credit securities underperform treasuries dramatically. It was a very quick hit. It lasted a few weeks and it started to recover, and it's been recovering ever since. But what you'll notice, even in your core fixed income portfolio for the month of March, you can see that it was impacted by those credit spreads widening. That's why you're seeing negative relative to performance in that area, because we did have a slight overweight to credit type securities. And that's your mortgage backed, your asset backed, your corporate securities within the portfolio. Any
Pat,
questions on the performance?
Yeah, this is Tim. I just want to make one comment while we're here. Since we've sort of biased the portfolio and equity to passive investing, our alternative is active. My observation through looking at a lot of portfolios, actively managed equity portfolios, has been, unless you were focused on growth names, you probably did worse than the index for this quarter. This is probably not a good quarter, not a good period for active managers who were looking for stocks that had some value. If you're buying stocks that look like they were discounted to the market and typical value fare, you got beat up pretty bad. So I think the indexes probably will show pretty well in broad peer for the quarter.
That's exactly right, Tim. And I think and that theme has been going on for more than just a quarter.
Yeah.
We've seen a broad-based rally, and I mentioned this in one of our meetings, in just a handful of stocks. And it's those technology stocks, those FANG stocks, have done extremely well during these periods of time. And value has been left behind for, I would say, 4 years now. So there will be a time where value will come back, but I'm not necessarily thinking it's going to happen anytime soon, because usually those value-oriented securities do better when it's in the early part of an expansion of economy. Interest rates are more normalized, not where they're at today. So I think any manager, active manager that had any kind of tilt to value struggled pretty tremendously over the last several years.
Yeah.
And that's all I had, unless there are any other questions.
Anybody have any other questions? Okay, thanks, Pat. Appreciate it.
Thank you.
Tim?
Well, good afternoon, everyone. We have
Hey, John and Tim, I'm sorry. This is Mark. I was a little slow on unmuting. Just, and maybe Tim, you could address it.
Yep.
Not Pat, at some point.
Sure.
I'm a big believer, as we all are, I believe, in rebalancing. But under the circumstances, what's the downside or the upside of rebalancing when we have such dramatic changes like this?
All I can say, Mark, is it's a terrific question that nobody has an answer to, because ultimately the path of the market determines whether in the short run you're rebalancing added value or not. There's a substantial body of research out there that suggests over the long term, rebalancing, daily, monthly, quarterly, you name your periodically or based on market events, adds value to the portfolio. there's little evidence that one approach is consistently better than another. So whether you do it daily, whether you do it using, sort of 2% limits or things like that. But, I think we're better off going with the rebalancing process than trying to sort of outwit the market, because it's just our instincts get in the way of that.
Yeah,
And
I was going to say, Kim, it's kind of interesting if you looked at April, and if you actually rebalance, you took some of the gains off the fixed income, allocated it to the equities, and then all of a sudden you had the big run in April on the equities, then you had to actually do the opposite. You had to rebalance away from the equities back into the fixed income. So there's a lot of detail that goes into it if you do rebalance, and the key is to make sure that you've got those ranges pretty tight that you can rebalance too. It sounds like Patrick's doing that with the 2% spreads. So
yeah, I always go back to 2008, even though the circumstances are different. What I would say is this: if we went back to 2008, I saw a number of clients who were very afraid of the downside. And if you had said, we're not going to rebalance, we're going to stick with our 20% loss, you would have lost a lot of value on the ride back. Circumstances are different now, but I think most would agree that at some point, the effects of this thing, there will be effects, negative effects, but at some point, there'll be a vaccine or some remedy for this. And so the economy will get back to normal. There may be some losses in getting back to normal, but I just think it's a good policy, Mark, to, continue to rebalance. It's over time and over a lot of studies seems to add value.
Thanks, Tim.
Sure.
And Pat.
Thank you.
Tim, did you want me to kind of address our?
Yeah, I just going to introduce, because of where we are, I think we're just going to do our compliance review. We don't have any other priorities. So Ken, you can run through that.
Yeah. So basically the lineup, it's on page 66 of the big deck, would be page 29 of our package. And it just looks at the fund performance summary, and the key column, as Tim noted, is our Sage View ranking, which basically looks at how we score out the investments from a metric standpoint. We talked a little bit about that last time, how we were tweaking that. We'll show that in a second with the investment policy statement. But the column, whenever it's in green, as we noted in the past, that's a good thing. You've got the top quartile and top decile funds that are actively managed, and we do a pass fail on the index funds. So all, despite the fact that absolute numbers, have struggled, the key is that the relative performance, at least from a macro global perspective, continues to be strong. We noted before, the kind of the real estate allocation, the high yield allocation, not a lot in total, about 1%, on the high yield side, a little under 3% on the real estate side. That has helped in the past. That clearly did not help in the first quarter, as those two areas got hit pretty hard. But, taking the very long-term perspective as we would want to do in this case, we still think that's a good allocation. So all in all, lineup, continues to be on a relative basis very strong, and we expect to see some bounce back, obviously, on the absolute numbers. The key is the timing of that. I just wanted to also, if we go to page, I think it's, let me just get us there on the investment policy statement update. We noted it would be on page 112, 113 of the deck, and it would be page 76 of our report. And this is the investment policy statement, again, that monitors and maintains the monitoring of the investment themselves. And As we discussed last time, we had a little bit of a tweak to how we look at the investments themselves. And if we go all the way to Exhibit 3 of the report, which can be found on page 93 of our report, 130 of the big deck, you can see again some of the tweaks that we talked about last time, just changing off that rolling 36-month returns, which duplicates many of those monthly returns, and replacing that with batting average, and then changing some of the time frames so that we have a more global approach to that. In comparing the new to the old, there wasn't a significant change in the scoring system, but we think this is a great way of, again, balancing out the whole approach. So that was really all I had. Tim, anything that you wanted to add?
Yeah, just I want to footnote our last meeting's discussion on the real estate fund. We had real estate fund fell into third quartile. We described to the committee how we were using what amounts to sort of a proxy for the fund performance that's in the plan because of the way the plan is set up. Fees are deducted topside, not from investments. And so we picked a fund that actually had fees deducted as a proxy for performance. That's what gave us the deduction of that extra level of fees is what brought that fund into third quartile. So Ken worked with SEI in our operations area to get a pure stream of returns on the real estate fund. So I think that popped back into at least top half, if not top quartile.
Actually, top quartile, yeah.
Yeah, so it really was sort of a phantom performance issue, but we've cured that now.
Yep.
Yeah, I think other than that, I recall we have 1% high yield, which we didn't like. In fact, our high yield target is 3%. So we've been avoiding putting that extra 2% at risk. And so considering 3% versus 1%, I'll take the 1%. We may want to think about this is the kind of time when we're most afraid of adding risk. Is probably a good time to do it, but I think we'll let this. This COVID situation work itself out for another quarter or two to see what until things stabilize a little bit. So that's I think all I have.
Do we need to do we have to approve the changes?
I believe you would. And again, we did redline it, so that can be done either now or at the next meeting if you want to take a look at it.
What's the pleasure of the committee, of the board?
John, this is Carol Pratt. Can you hear me?
Yes.
Oh,
Hi.
good. I'm sorry
we can see you.
Good. I was late, but I heard all of the meeting. I just couldn't get my upstairs computer to work good. So, so I just wanted to make sure I was alive and well on the screen.
We see you.
Okay, great. So I've heard everything except I didn't know if you had authorized the payments yet.
Yes.
Yes.
You did. Okay. All right. But I can vote on this next thing because you can hear me. So good.
That's up to them, whether they
So
wanna put it
do
on the
people
next
want
agenda.
to wait and take a look at it over the next quarter, or do you want to take action on it now? I could go either way.
Hey, John, I think from my standpoint, we talked about this last time. So, if folks are ready to vote, I certainly am.
Okay, I'm in favor. Is that a motion, Mark?
Yes.
You have a second?
Second.
Oh, nodding your head. Was that a second?
Second.
Dennis, was that you seconding?
Yeah, that's me.
Okay. Any discussion? All in favor, say aye.
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 Okay, approved. That's all you had, Tim?
Yes.
That's all we have. Yes, John. Thank you.
Okay, next on the list, let's see, the actuarial evaluation. Oh, we didn't do a vote to accept
Yeah.
and file the report?
Yeah.
Okay, we have to do a vote to accept and file the report from last time. So we need a motion for that, if people are comfortable.
This is Mark, so moved.
What's that?
This is Carol. I second it.
Mark, was that you Mark?
Yeah, yes, John, yep.
Okay, Mark to the motion, Carol seconded. All in favor, say aye.
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 Motion approved. And then interest rate on employee contributions, the final page in the pack there. On, now, yeah, we just need a motion to accept and file this information.
I so move.
Okay, Carol moved,
Jason second.
Jason seconded. Okay, any more discussion?
Great.
Nope. Okay, if not, all in favor say aye.
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 Motion approved. Now we're scheduled for the next meeting on August 13th. And we were supposed to have a presentation on cash balance plan, and with all the COVID going on, I missed that. So we will get that scheduled for next time.
Oh, good, because I was confused about that.
Yeah, so we will have that on the agenda. Okay, and anything else from anybody? If not, I would entertain a motion to adjourn.
So moved.
Motion from Dennis. Do we have a second?
Yep.
Second, this is Mark.
Okay. All in favor, say aye.
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 Motion carried. Thank you, everyone. Stay safe and
See you next time.
see you next time. Yeah.
Thank
care.
you.
Bye now.
Bye, everyone. Stay safe.
Bye.
You
Thank
will.
you.
Be safe.